In 2025, the conversation around wealth and taxation has taken center stage, particularly regarding how the rich manage to pay little to no taxes legally. This topic is not just a matter of curiosity, it's a crucial aspect of financial literacy that everyone should understand. The wealthy often employ a variety of tax strategies that exploit loopholes in the tax code, allowing them to minimize their tax liabilities significantly. From utilizing offshore accounts to taking advantage of capital gains tax rates, these strategies can seem complex and out of reach for the average person. However, by breaking down these practices, we can demystify the system and shed light on how wealth accumulation often operates outside the traditional tax framework. Understanding these tax strategies is essential for anyone looking to improve their financial literacy. It empowers individuals to make informed decisions about their finances and encourages a broader discussion about equity in the tax system. As we delve into this topic, we'll explore the various loopholes and strategies that the wealthy use, aiming to equip you with the knowledge to navigate your financial future more effectively. Tax loopholes are provisions in the tax code that allow individuals or corporations to reduce their tax liabilities legally. Essentially, they are gaps or ambiguities in the law that can be exploited to minimize taxes owed. Common examples include deductions for mortgage interest, capital gains tax rates, and the use of offshore tax havens. These loopholes can significantly benefit high-income individuals, enabling them to pay a fraction of their income in taxes compared to average earners. Wealthy individuals often exploit these loopholes by employing sophisticated tax strategies. For instance, they may invest in assets that appreciate over time, benefiting from lower capital gains tax rates when they sell. Additionally, they might use trusts or offshore accounts to shield income from taxation. This strategic maneuvering allows them to retain more of their wealth, further widening the gap between the rich and the rest. The impact of these loopholes on the overall tax system is profound. When high-income earners pay less in taxes, the burden shifts to middle and lower-income individuals, who may not have access to the same strategies. This imbalance can lead to a less equitable tax system, raising questions about fairness and the sustainability of public services funded by tax revenue. Understanding these loopholes is crucial for fostering a more just financial landscape. Offshore accounts and tax shelters are financial tools that allow wealthy individuals to manage their assets in jurisdictions with favorable tax laws. Essentially, these accounts are held in banks outside of one's home country, often in places known as tax havens. The legal implications of using offshore accounts can be complex. While it is legal to hold money in these accounts, failing to report them to tax authorities can lead to severe penalties. Popular tax havens include countries like the Cayman Islands, Switzerland, and Luxembourg, where low or zero tax rates attract high net worth individuals seeking to minimize their tax burdens. These jurisdictions often offer strict privacy laws, making it difficult for governments to track the assets held there. However, the use of offshore accounts raises significant ethical considerations. Critics argue that these strategies contribute to income inequality and undermine public services by depriving governments of tax revenue. While proponents claim that offshore accounts are a legitimate way to protect wealth, the perception of tax avoidance can lead to public backlash and calls for reform. Understanding the implications of offshore accounts is essential for grasping the broader conversation about wealth, taxation, and social responsibility in today's economy. Capital gains tax rates significantly favor the wealthy, primarily because they are often taxed at a lower rate than ordinary income. Ordinary income, which includes wages and salaries, is taxed at progressive rates that can reach up to 37% in the United States. In contrast, long-term capital gains, profits from the sale of assets held for more than a year, are typically taxed at rates ranging from 0% to 20%, depending on income levels. This disparity incentivizes high-income individuals to invest rather than rely solely on earned income. Wealthy investors often employ various strategies to minimize their tax liabilities. For instance, they may focus on long-term investments, allowing them to benefit from lower capital gains rates. Additionally, they might utilize tax loss harvesting, where they sell underperforming investments to offset gains, effectively reducing their taxable income. Successful investors like Warren Buffett and Jeff Bezos have capitalized on these strategies, accumulating vast wealth while paying relatively low tax rates on their investment gains. By understanding how capital gains tax rates work and the investment strategies that leverage these advantages, individuals can better navigate their financial futures and make informed decisions about wealth accumulation. Charitable donations offer significant tax benefits for high-income earners, allowing them to reduce their tax burdens while supporting causes they care about. When wealthy individuals contribute to qualified charitable organizations, they can deduct the amount of their donations from their taxable income, effectively lowering their overall tax liability. This deduction can be particularly advantageous for those in higher tax brackets, as it allows them to offset a substantial portion of their income. Many wealthy individuals use philanthropy strategically to enhance their financial planning. For example, Bill and Melinda Gates have established the Bill and Melinda Gates Foundation, which not only addresses global health and education issues but also provides substantial tax deductions for their contributions. Similarly, Mark Zuckerberg and Priscilla Chan have committed to donating a significant portion of their wealth through the Chan-Zuckerberg Initiative, leveraging their philanthropy for both social impact and tax benefits. However, the widespread use of charitable contributions by the wealthy can have complex implications for tax revenue. While philanthropy can address pressing social issues, it also means that substantial amounts of money are diverted from government coffers, potentially impacting public funding for essential services. Understanding the interplay between philanthropy and tax policy is crucial for evaluating the broader effects on society and the economy. Corporations play a significant role in helping the wealthy avoid taxes through various strategies designed to minimize tax liabilities. By establishing complex corporate structures, high net worth individuals can take advantage of legal loopholes and favorable tax regulations. These structures often include limited liability companies, LLCs, and S corporations, which provide flexibility in income distribution and tax treatment. LLCs allow wealthy individuals to pass income directly to their tax returns, potentially benefiting from lower tax rates. S corp, on the other hand, enable owners to avoid self-employment taxes on a portion of their income, further reducing their overall tax burden. Both structures can be used strategically to shield income and assets from higher taxation, making them popular choices among affluent individuals. Several companies are known for their aggressive tax strategies, leveraging corporate structures to minimize their tax obligations. For instance, tech giants like Apple and Google have faced scrutiny for using offshore subsidiaries to shift profits to low-tax jurisdictions, effectively reducing their tax rates significantly. These practices highlight the broader implications of corporate tax avoidance, raising questions about fairness and the impact on public revenue. Understanding how corporations facilitate tax avoidance is essential for grasping the complexities of wealth accumulation and its effects on society. The wealthy often exert significant influence over tax legislation, shaping policies that favor their financial interests. This relationship is primarily facilitated through lobbying, where affluent individuals and corporations invest substantial resources to advocate for specific tax reforms. Lobbyists work to persuade lawmakers to enact legislation that can lead to lower tax rates or favorable treatment for certain investments, effectively tilting the tax code in favor of the rich. Examples of legislation that benefits the wealthy include the Tax Cuts and Jobs Act of 2017, which significantly reduced corporate tax rates and provided substantial tax breaks for high-income earners. Such policies often prioritize the interests of the affluent, allowing them to retain more wealth while shifting the tax burden onto middle and lower income taxpayers. The implications of this influence on the average taxpayer are profound. As tax policies become increasingly skewed toward the wealthy, the financial strain on everyday individuals can intensify. This dynamic can lead to a growing wealth gap, as public services funded by tax revenue may suffer due to reduced contributions from high-income earners. Understanding the interplay between legislative influence and tax policy is crucial for recognizing the broader effects on economic equity and social justice in society. In this exploration of how the wealthy manage to avoid taxes, we've uncovered several key strategies that play a significant role in their financial planning. From utilizing offshore accounts and tax shelters to leveraging capital gains tax rates and charitable contributions, high net worth individuals employ a variety of tactics to minimize their tax liabilities. Additionally, we've seen how corporate structures and legislative influence further enable the affluent to navigate the tax system to their advantage. Understanding these practices is crucial for anyone looking to enhance their financial literacy and make informed decisions about their tax strategies. By being aware of how the tax code can be manipulated, individuals can better advocate for a fairer system and protect their financial interests. If you found this discussion insightful, we encourage you to engage with our content. Please subscribe to our channel for more informative videos, like this one, to show your support, and share it with friends and family who might benefit from understanding these important financial concepts. Together, we can foster a more informed community that is empowered to navigate the complexities of wealth and taxation. Thank you for watching.